Thank you for joining us for our Economic Power Panel webinar this morning. We certainly hope you and your families and your colleagues are all healthy and safe and adjusting to the ever-changing environment that we have around us. Just as we're getting settled, we're actually going to put up a quick poll to get a temperature check while you're getting settled in. If you can enter that in there and give us an idea how you're feeling, and then we'll get started. We'll just give you a moment or two to put your entries in, and then we will give you some of the results of that as we go through the process. Okay, we'll leave that up or move it around there a little bit, just to get started. These are indeed unusual times, and some of which we couldn't have imagined 5 months ago, let alone 3 months ago. Our lives and the economy have changed so much in that time, seemingly day by day. So while we couldn't host our usual in-person property summit, we still wanted to share with you some valuable information, insights. In particular, we put together our panel today that some of the gentlemen that you've seen year after year, and the interaction between them is always entertaining. But we're going to get started on the economy, go from a global level down to a national level, and then into the provinces, then get into housing and mortgage market trends, and then some expectations for the future and where that goes. So why don't we take that poll down and we can get started. Just a couple of housekeeping items. We will be recording this session. We will provide you with a link after this part. Everyone's on mute, and we'll ask if you do have questions. You can ask those during the piece through the Q&A feature on Zoom. If you happen to be having technical difficulties, which you probably can't hear me if you are, we do have staff standing by to deal with those. So please just put those in the chat and we'll try and help you out as quickly as we can. So we have about 30 to 35 minutes for questions and responses from our panelists. And run through that part of the process. Then we have some questions that we've already gotten from the audience, and any other questions that come up during the session, we'll put those in. And we are going to do more polling to this. So it will be an interactive session to get your feelings on what's going on and give you that feedback relatively quickly on those polls so you can see what other people are thinking. Also, at the very end of this, you'll be going through a bit of a quick questionnaire survey to give us some impressions on this session, as well as other sessions that we are thinking of putting together in the future. But now for the real reason for us being here, let's get down to our economic power panel. And the gentlemen that we have here, I don't think need any introduction at all, but to go through that quickly, we've got Benjamin Tal from CIBC World Markets, Derek Burleton from TD Bank Group, and Robert Hogue from RBC Royal Bank. Thank you very much, gentlemen, for joining us today. And let's get started with I think the global view of the economy. And perhaps each one of you could share your base case or your view of the global economy and how it's going to impact Canada, and basically what you really think is going to happen. Maybe we could get started with Derek on that one.
Yes, good morning all. Sorry we can't be there in person this year. It ends a long string, and I've always looked forward to the breakfast in particular. So hopefully we get back on track next year. The global economy, gosh, it's a tough thing. I mean, the models just aren't working as well as they used to. Never before have we seen, or what we're considering, sudden stop economics, kind of shutting down large parts of economies for an extended period. You know, two things we're wondering. A, the depth of the recession. We're amidst it. We're still getting data on how deep the recession is going to be. April, I think, is going to mark the worst of the drop. Not that we're going to see declines end in April, but the deepest drop will be in April. And now as economies are gradually reopening things, we should start to see things gradually improve, contractions declining, and hopefully on the growth track in the third quarter globally. But the duration is the other part. I think we're wondering what letter shape the recovery is going to be. Is it going to be an L, which is stagnation? Is it going to be a V? I think most people ruled out V. U is probably where the consensus stands. So that's where we stand in general shape of recovery. A few spots of the world I'm particularly worried about right now. Emerging markets. They were among the first into the crisis. We all know that China was kind of the epicenter where it started, the outbreak. But financial markets, when they plummeted back in the early part of the year, the capital went chasing out of emerging markets. They were very hard hit, currency depreciations. And so they were kind of first brought in. Not that advanced economies weren't hit, but I think they'll be also last out, because what we're seeing now is financial markets have improved. Now a lot of these emerging markets are getting hit by big outbreaks of infections later in the game, Brazil, India, and the like, and that's going to slow their pull out of the mud. The other spot I'm concerned about would be the Eurozone. They've got a lot of challenges, divisions. They've got a very deeply hit southern part. Not all economies have been hit in Europe, but particularly Italy, where infections were worse, deaths were worse. And how you bring together some of these divisions and do a coherent policy. You're starting to make some inroads there, which is good. So those are two parts of the world I'm worried about. But bottom line, we're going to see a sea of major contractions across virtually all economies this year, and the hope that we'll see a bit of a bounce back in 2021.
Excellent. How about Robert?
Well, I think Derek touched on a number of points there, but I think they really highlight the complexity of the picture. How different parts of the world were hit at in different times, and the risk going forward. And I agree with the point that we've been hit, we've been shut down, our economy both locally and nationally and globally. But it really is about to us at this point, what will the recovery look like? And we can talk about in different letters our view. If you want to characterize how it's more of a check mark than a V, a W, an L, a U, whatever. Just or some call it the Nike swoosh, kind of a fairly significant dip initially, and then kind of a slow grind. But what is clear to us, and that implies some kind of smooth recovery pattern, and chances are it's not going to be smooth, and probably anything like smooth, but kind of directionally, this is where we might end up going. But what is clear to us, notwithstanding the shape, the actual shape, is that to go back to where we were pre-COVID-19 is going to take a long time. We're probably looking into 2022 before we start to feel that now we're back to where we were. The odds or the risk of further waves in the pandemic, or some we're globally with the global supply chains, we're globally integrated, and many things can happen outside of our border, outside of our control, that could have implications on our recovery, but the global recovery as well. So the bottom line for us is it's going to be a slow recovery. It's going to be gradual. It's probably going to be bumpy. And to talk about full recovery, we're talking, a long time from now, probably if we're really lucky at the end of 2021, but more than likely, probably the back half of 2022.
And Benjamin.
Yes, I think that it will be, first of all, we have to try to define what it is. And the answer is that we cannot define it. When you have a negative GDP at 40%, then you know that it's not something that we can define. What is it? Is it a recession? Is it a depression? It's not any recession in a normal sense of the word. And it's not also a depression, because in a depression, like in 1929, you are basically in a free fall. There is nothing beneath you. You lost your job, good luck. This is not the case, because we know one thing. This crisis has an end game. This end game, of course, is a vaccine. So what we do now, governments, central banks, corporations, individuals, what we are doing now, we are basically buying time until we reach that point. So when I try to think about the trajectory ahead, I think it is useful to separate it into two periods. One is before the vaccine and one after the vaccine. So before the vaccine, let's say a year and a half, whatever the time is, what I see is basically a situation in which the economy will be on and off. What I mean by that, I think it's not a question of if, it's a question of when we're going to have a second wave after this one. Every pandemic in the history of the universe experienced more than one wave, including the Spanish flu that had 3 waves. This will not be different, especially if you look at what's happening outside now. The sun will be shining, the birds will be singing, and we will be cheating on social distancing. It's human nature. And I think that's exactly what will happen. So I think that this summer will be wonderful. Optimism will reach a peak, relatively speaking. The number of cases maybe will go down. And then we will have the flu season, and October, November, December will be very confusing, and we might see a second wave. Nobody knows how big it will be, but we know what to do now. It means that the government will slow it down a little bit. So I see an on and off economy for the next year or so, what I call a zigzag economy. And that will impact the ability of companies to recover productivity, because you cannot really make plans. So this zigzag economy will dominate the agenda over the next year. Then we will have, let's be optimistic and say we will have some sort of antiviral medication or a vaccine, and we'll be on the other side of this crisis. Even then, the recovery will not be full. Let me explain what I mean by using the unemployment rate as an illustration. The unemployment rate before the crisis was 5.5%. Now we are going to what? 13, 14%? We lost 3 million jobs over the past 2 months. We know the numbers. Now, of course, the vast majority of those jobs lost on a temporary basis. They will be regained when we start recovering, and especially after there is a vaccine. But I think it will be naive to believe that this kind of a crisis will not lead to some long-lasting damage. Some jobs will not be regained. Some companies will not open again. So we will have a situation in which the unemployment rate will go down, but let's say to 8%. So a move from 5.5 to 8% unemployment rate is usually what you see in a recession. So what I'm telling you here, that we will be recovering into a recessionary territory. It will be a recessionary recovery. Even after the vaccine is available, we will have to go through that recession, and then the trajectory will be clear, which will be maybe 2022 if we are lucky. So 2 periods, the zigzag economy and a recessionary recovery. That's the way I see the situation.
Okay, that's great. Thank you very much for that. And what we'll do now is just quickly, before we move on to more specifically the Canadian marketplace, we'll put up the results from that first poll so people can get an idea of what they've been going through. Certainly interesting, the primary response being they're okay through this time, although there's still some people who are quite challenged and then finding it tough. And some people find it a walk in the park. So that's really interesting from that perspective. But let's get more focused on the Canadian economy specifically, and give you remarks about the global economy. Globalization seemed to be a buzzword for so long, but specifically as we come out of the lockdown and we start reopening, we've got the shape of the recovery, which I think all of you have talked about briefly. We are going to put a poll in here from the audience just to get their view of that now that you've preempted some of those ideas, to get an idea what the audience thinks are going to be the type of recovery or shape of recovery. So we'll leave that up for just a few moments there, and then quickly following that on whether there's going to be a second wave. And I know, talking to you gentlemen prior to the session, that you're all expecting a second wave. So we know your results for the survey. So we'll move on to the second poll quickly. I'll just give you a moment there. So moving on, given those views on the global and the Canadian economy, maybe we can share your thoughts just on that shape and timing, but maybe more specifically about how through the recovery, how going from a globalization to a more nationalistic view, is that going to really impact the recovery? And maybe we'll start with Robert on that.
Well, I mean, we've already discussed quite a bit of the kind of recovery we might see, and I agree with Derek when he said that April is going to prove to be quite possibly the bottom. We have starting to have a sense of how deep that bottom has been. But as we get a bit more data going forward, I think that's going to firm up. Now, going forward, it really is, at least the initial go will be about how quick the economy is going to be reopened, and it's going to be uneven across the country. We're seeing provinces moving at different speeds, moving different phases, and that will dictate essentially the first, let's call it, phase of the recovery over the second half of this year. And to get beyond that, I think what we'll find out in the coming months is how much of the economy's capacity have we lost through this downturn. And this is very hard to tell at this point. We know that probably a number of businesses won't make it. Now, that being said, there's been tremendous programs and support being provided by all levels of government, from the federal to the provincial to the local, to ensure that as many businesses as possible, we can bridge them through this, this period, so that they can be on the other side of the valley, still around and able to resume operation to some degree. We're not naive enough to expect that businesses are going to snap their fingers and be back at full operation. Like I've said in initial remarks, I think our view is that things are going to be pretty gradual, and for some of the businesses, or many of the businesses. And so I think, but then the period that will follow the initial stage, to me, is a fairly big question mark, in the sense that we're probably going to be stuck with a high unemployment for a period of time, which means that consumption and Canada consumer spending is going to be lower than would have been otherwise for a period of time. And I think that this is going to be something to, I'm not quite sure the degree to which policy can address that, I think, and maybe joining Ben on his remark, although the time frame probably is much different if we're talking about waiting for a vaccine to show up, and then talking about getting into some kind of a recovery, recession, or recession recovery. I'm not quite sure which order you put it, Ben, but then to me, once you get into later stages of this year, into 2021, there'll be the degree to which unemployment, high unemployment, is going to hamper that kind of momentum that's going to build in overall the overall activity. So we don't have many answers, and then usually in those talks I start by saying we've lost, as economists, we've lost most of our traditional guideposts. We are really in many ways uncharted territory. So we're trying to grasp into any kind of tidbits of information, either real time or not. We've been digging into our own, a database at RBC, for example, on credit card and debit card spending, to get a sense of, of direction and which parts of the country and that's being affected most. So we're, quite willing to look into less traditional sources of economic information or indicators. But as more traditional numbers start to fill in a bit more, we'll get a better sense of how much have we lost in terms of economic capacity going forward.
Okay, good. You touched on the employment levels and some of the things there, and Benjamin also touched on that briefly. Derek, maybe you could share with us not just the unemployment levels, but maybe some of the industries or jobs that are not coming back. So we've lost a lot of jobs, some coming back. Are there particular segments that are maybe not coming back?
Yeah, and this is a big question. You can't just paint an economy with one brush. A lot of talk about U-shape as being a baseline forecast, which, given all the chit chat about downside risk, maybe about the best outcome, but that's in general. I think when you look across the sectors, there are probably a fair number of industries that are going to be looking at an L-shape. In other words, not really rebounding much off their April lows. I think the usual suspects there would be air travel. I'm concerned about. Now, I wouldn't go as far as to say people are never going to fly again. We knew after 9/11, the first comment was that nobody's ever going to want to get on an airplane again, and that wasn't true. People did eventually get back to flying, so I can see a return to flight, but it's going to take a while. So, a pattern for recovery in air travel will be very slow, almost like an L. Recreation, it's going to take a while for people to get back feeling comfortable with the same kind of activities. These are all large parts of retail, same thing. On the other side, there are going to be sectors that are going to V-shaped. Some of the areas that are going to come out with punch. I mean, the Zoom types, industries, IT, that kind of thing. We're going to see a large shift in demand to some of these newer budding industries as the economy adjusts to somewhat of a new normal. So we put out recently a report that kind of takes sort of the 23 largest industries in Canada and maps them into recovery camps based on what we feel are sort of the U-shaped prospects, V, and definitely a skew towards the L on the downside. But in terms of the jobs lost, I think that's a great question. I think one of the things we're kind of banking on is in the labor force survey, there's a question that households have to answer. Is your layoff temporary or not? And the bulk of the unemployed, and we do know they're counted in Canada, about 1.9 million job losses, unemployed. About 90%, close to 90% say that they're on temporary layoffs. So they've been communicated, this is just going to be a temporary thing. The challenge is that the longer this thing stretches out, we're starting to get a little bit of a feel for that, where you're starting to read in the headlines, announcements of big layoffs, HSBC overnight, talking about, significant restructuring, that some of the plans for temporary could become more permanent. And this is the biggest risk, something that Governor Palau stressed the other day. The biggest risk here is time. The longer it takes for reopening to happen, a second wave, if that slows down the pace of reopening, then the more stress, the more financial stress, the more bankruptcies and how that can cascade. So if I'm going to lose any sleep at night, it's over this financial element that we're not baking into our baseline. We are implicitly, it's going to take longer to get back, but, we don't have, very good models that work out bankruptcies to the 10th of a decimal and build my worries. So hopefully we can continue to see the reopening happen, and that'll mitigate the risk of this, along with all the government supports that are trying to bridge households and businesses through the other side.
Okay. And Benjamin, just in terms of the unemployment levels where they are now, closing in on 17, 18%, coming back, what do you think that 6 months out view of unemployment level is going to be like?
Yes, I think it will be high. It will not be as high. I totally agree. A significant number of them were lost on a temporary basis. This job the demand for the job did not disappear, simply frozen. Your name is still on that cubicle, just waiting for you. And I think that in this sense, if you look at the numbers, I think that we're probably reaching peak when it comes to the unemployment rate, and it will start going down. But the most important aspect of it is also the nature of the job lost over the past 2-3 months. We're basically talking about low wage jobs that were lost. In fact, if you look at the quality of employment in Canada, it went up. It went up not because of more people are working in better jobs, but the number of people in low quality jobs went down. That's why wages went up by 10%, like wage income, not because of the fact that we got a raise, because there are more high paying jobs left. So this is not an even distribution of job loss in any significant way. And that's something that we have to consider. And that's why government policies are so important here. So I don't think that the government will be able to slow down the process of providing help in any significant way, especially if we have a second wave. So those government programs are here to stay.
Okay, let's throw up the results from that poll, the shape of the recovery, and put in that, show you up those responses, and knock a lot of people in the W camp. Now, we didn't put an ongoing W, that zigzag response, and incredibly popular as well. But certainly there's some people that think that L and U much more likely than the D response there. And in terms of a second wave, I think that we throw that result up, we'll see likely that the vast majority of people thinking that there's a second wave coming, yes. Some people not thinking that, that maybe this summer, through the summer, we somehow find a vaccine, although I know that's, all the projections are that's still a long way off, and we'll go from there. But let's move on to the provinces, and quickly, Robert, maybe you could give us a view by province, who are the winners or potential provinces that are going to take longer to recover.
Yeah, I'm not quite sure they're winners in the whole thing here. It's a more degree of shock being felt, and well, so far we know that the initial shock was probably felt the most in Quebec, based on the numbers that we've been looking at so far, and it's sort of parallel with the health situation has been in Quebec. It's where number of cases have been the highest in Canada. But our view is that through this recovery, where the provinces that will be hit, well, that will be where the shock is going to take the longest to be wound down will be the oil-producing provinces. Because when you look at Alberta, for example, and Newfoundland, Labrador, and to a lesser extent Saskatchewan, they're being hit doubly here, and there's the COVID-19 hit plus the collapse in oil prices. Our view is that oil prices will recover, but it'll be a slow grind as well. We don't see oil prices back to where they were, say, 6 months ago, for example, anytime soon. So the initial shock might not have been as brutal in Alberta as been in Quebec, for example, not that far, but not quite as much, but it'll take much longer to recover thereafter. So our view is that we can see, GDP in Alberta being down in the double digits. I think our latest forecast was something like minus 11%, which 2015-16 was the worst recession in Alberta. And we thought 2020 will be the first year that we'll go back to 2014 level of activity. And now it's being hit by something that's even worse. So really, things are really rough in Alberta. And where provinces are most likely to bounce back a little bit quicker, our views that probably BC, Manitoba is probably the one that's going to shrink the least this year, partly because it took a little bit longer to shut down its economy. It was one of the first ones to start reopening. And in BC, it looks like it's got some more, I guess, going forward for it. For example, some major capital projects look like they're back, or to a certain degree. So Alberta probably the worst, and BC and Manitoba being not quite hit as bad.
Okay, Derek or Benjamin, anything on the provincial outlook?
Yeah, the one I do worry about as well is Quebec. They've gone from stunning swing. They went from among the lowest unemployment rates in Canada to the highest. 17% was the last unemployment rate. And by the way, these unemployment rates that they're talking about, they're understating the true amount of unemployment, because StatCan's having a difficult time classifying people into, well, are you in the labor force or you're not, because they don't meet the standard definition that they've been laid off, but they're not actively looking for work, so they're considered out of the labor force. So an unemployment rate in Canada at 13 is more like 20 right now. So it just shows you underscores how unusual these times are. But Quebec is gone from very low unemployment to 17%. CMHC data show on the deferral requests for mortgages, about half were between Alberta and Quebec. And I think it's stunning that Quebec is right up there at the top of the list, along with Alberta, which one would reasonably expect. I think together they're about 50%, whereas Ontario was, I think, about 18% of mortgage deferral requests. So Quebec is a province I worry about. They're going to be an underperformer this year as well, along with Newfoundland and Labrador. The Maritimes, I think, will fare quite well. In general, provinces that are less densely populated are having less battles with COVID in terms of infection rates. They're better positioned to have a less of a depth of decline and in better shape to kind of rebound.
Okay. And Benjamin, any thoughts on provincial?
Yeah, I think we are good. The only thing I would say is that it's interesting talking about Quebec is that Quebec is the most infected province, and it is the one that is opening up in the most aggressive way. Go figure. But I'm okay.
Okay.
Cover that.
Well, let's move on to something else that you gentlemen have referenced a couple of times, is the government response. Certainly they took dramatic action very early on, and we're going through that right now. But let me get your thoughts. Maybe we'll start with Benjamin on the long-term impact and consequences to that action.
Yes, so let's start with the Bank of Canada and then the federal government very, very quickly. Clearly, what you're trying to do is to achieve three things. One is to inject enough liquidity into the system, so the system will be able to function, the financial system. Second, of course, is to provide short-term help to people who were impacted, and then provide enough demand in the economy to get us out of any deflationary cycle. That's basically what we're trying to do at this point. Now, you look at the Bank of Canada, I think their action was fantastic, quite frankly. I think they didn't play any games, no baby steps. They went all in. We're talking about a full-scale quantitative easing of $5 billion a week, government bonds. They are in provincial bonds. They are in corporate bonds. They are in the BA market, in the repo market. You know the story. Very, very aggressive. That's exactly what we need. And if you look at spreads are actually moving in the right direction. Basically, mission accomplished. Liquidity is back into the system. The financial system is functioning. Now, of course, there are some issues here. One is the credibility of the central bank. Let's face it, the Fed, the Bank of Canada, they are not central banks anymore. They are government agencies. They are crown corporations, because the government is issuing bonds and the Bank of Canada is removing all those bonds from the secondary market, keeping borrowing costs relatively low. That's basically a government employee. So what we have to make sure is that we reestablish that credibility over time. Now, this is not a criticism. We had no choice, but that's a derivative of that. So that's the Bank of Canada. The big question, of course, is you print money. Basically, it's helicopter money. We know the story. You print money to finance the government. This must be hyperinflationary. And we are talking about deflation. So that's the question. The question is to what extent, when we recover, we'll see inflation. I'm not in the camp of inflation anytime soon, because I think that, remember, this is not new money. This is not adding to the system. It's replacing lost income. Second, we know that Japan, the US, the Eurozone, they were printing money forever. Inflation is missing in action, because what you need is not only money supply to rise, you need the velocity of money to rise, the rate at which money is exchanged again. This is not happening. If 2 years from now, the government, the Bank of Canada will continue to print, then we have an issue. But I don't think that will be the case. So I'm not losing sleep over inflation anytime soon. In fact, the opposite is the case. The risk at this point is disinflation, deflation. That's the Bank of Canada. Very quickly, the government. You know the story, you know the programs. I think that the debate now, and we are engaged with the government trying to figure out how to phase it out, how to basically slow down all those programs. It's not going to be easy. For example, if you look at this CERB, the $2,000 per person, it's fascinating. You know, if you make up to $1,000, you still collect the $2,000. Eh? If you make $1,001, you lose the $2,000. So what's your motivation to make this extra dollar? None of those programs are perfect. In fact, many people probably take advantage of them. There's a lot of money being lost, wasted, but there is no choice because we are making it up as we go. Without even knowing, the role of the government is rising and rising and rising. Without even knowing, we are basically establishing the infrastructure, building the pipelines, the plumbing for tomorrow's social assistance program for Canada, without even knowing that, on the fly. So that's what's happening here. And again, it's not perfect, but it's not a criticism because we had no choice. I will not get through all the programs. They are not perfect, but the key question is, who is going to pay for all this? And the short answer is, obviously, nobody. This money will be recycled, of course. And two things happening here. One, our debt to GDP ratio started this crisis from a very good position relative to any other OECD country. And then we borrow at extremely low interest rates, and we refinance existing debt at much lower interest rates, which means that we calculated that you can borrow extra $400 billion without seeing interest payments rising by 1 cent. This is very different than what Paul Martin did in the 90s when interest payments were rising 5 times faster than GDP. This is not the case now. In fact, you can clearly, regardless what your trajectory is, clearly picture a situation in which interest payments will be rising more slowly than GDP. So the debt to GDP ratio can actually go down even if you borrow extra $400 billion. So it will be recycled. Nobody will be paying for it in the way that we think. You don't have to inflate it. It's not perfect. It's not good. It's not ideal. But given the situation, it's actually a good position to be. And are we going to raise taxes to finance that? There will not be need to do so, although I suspect that after the crisis is over, you will see an increase in the capital gain tax, but that's because they wanted it to start with, and that would be a good opportunity to do so. But overall, that's the way I see it.
Okay, very good. Derek, maybe you could make some comments on that as well and blend in your view of interest rates and where those might go as well.
Well, that's one of the easiest forecasts these days. I mean, zero is a number that resonates in my head for rates. I mean, we don't expect interest rates to go anywhere anytime soon. We're looking at midway through 2022 of effectively rates at the lower bound. There's a risk of negative rates in Canada, but something that the Bank of Canada doesn't consider a tool presently. So I wouldn't expect it's going to happen in the very near term, and then it just depends on how the economy performs going forward. Which means yields are going to be anchored very low. I don't expect inflation to break out, as Benny spoke of. Perhaps it's something globally we have to deal with in 2022, presuming the economies improve. But that would be the risk to yields, that they could bounce back a bit more forcefully. But government debt it's a big concern. Understand the affordability of government debt is better with rates remaining at zero, but I don't think we're even close to the end of all the stimulus and money that's being spent. With Bank of Canada using a lot of its tools already, not that it's used all of them, but it doesn't have that much room to go. It's going to put more pressure on the federal government, which is in the best fiscal position of the levels of government, to step up. They're going to have to help cities. Cities are in very dire straits right now with the loss of revenues. All these programs likely to get extended. We've already heard of the wage subsidy program getting extended. It's going to be very difficult to extract. And the expectation is governments will be there to support. So I don't know where we're going to end up with the deficit and the debt level. Canada has a AAA rated debt right now. It's among the few. They'll probably lose it, I would imagine, but they'll still be relatively highly rated. So, I think we'll be okay. But, I do think at some point taxes will go up, spending will have to be cut. When? I don't see it happening in the next year, that's for sure. I think as long as the Bank of Canada investors are buying government debt, there's going to be, investors will be okay. So, but going out 3 years comes down a little bit to the appetite of Canadians. Think of Harper after the last crisis. They had a plan. They were temporary measures. As we emerged from the recession, they had a 2-year program to lower the deficits, and that was fully supported by Canadians, and they did it. Canadians don't want it, then I think that's going to be an impediment, and then it comes down to whether markets are going to demand it at some point. That would be the next step. But I do think it's going to be an impediment to potential growth in the longer run, cruising speed, and that I think a lot of factors, lower population, these all feed into a view on potential growth that's going to be less than the 2% in Canada that we're accustomed to.
Okay, great. Well, let's move on actually to housing and prices in the Canadian marketplace and the impact of that, the economy on those pieces. And just before we get started on that from the panelists, let's get a quick audience poll on that. The polling or the reports around the economy have been everywhere from positive growth to prices to vast reductions. So sort of interesting to get your thoughts on that part. We'll just poll the audience quickly on their thoughts on that. And then we'll move on and maybe we'll get Robert to get us started on this part here. And it could be provincially and it could be based upon geographic or housing types. But your thoughts on where prices and volume of transactions are going to go?
Well, I think we have the answer goes into phases as well. I think very near-term prices or property values are probably not going to change that much. The thing to keep in mind is that going into this crisis, most markets in Canada were very tight. Cases of GTA, for example, Vancouver had tightened up quite a bit in the year and a half leading into the crisis, and the markets like Ottawa and Montreal were probably the tightest they've ever been. So the thing to say about COVID-19 is that so far, at least, it has not created any imbalances. It has affected both the demand side and the supply side quite equally. I would argue when you look at the most recent market statistics on the resales and new listings, for example, they fell pretty much in tandem. So whatever the balance between demand and supply going into the crisis, they're pretty much the same. If they were very tight, it's still tight. And for markets like in Alberta, for example, we're a little bit loose, they're still a little bit loose. Now, so that's for the near term. We don't see that changing that much, probably over the next few weeks, potentially a month, maybe the next couple of months. But beyond that, though, I do expect that some imbalances are going to show up. I'm a little bit concerned about the next cohort of first-time home buyers coming into the market, probably in the fall and beyond, when they've been traumatized. Many of them have lost their jobs or lots of hours, or maybe wages were cut, so they're not probably in a position to be active in the housing market that they would have been otherwise. And on the supply side, I'm a little bit concerned at this point. I'm not quite sure that would be a base case scenario of a wave of listings. But for example, investors, I'm thinking more specifically of Airbnb or short-term rental investors, for example. Some of them are going to be in trouble. We're starting to see some evidence and anecdotes that they are turning towards the longer-term rental market to a larger extent now, because let's be clear, tourism is pretty much dead right now. It's likely to remain very, very slow for an extended period of time. But I do expect also that some of those investors start to put their condo units in particular into the resale market probably in the months to come. So I can see that some imbalances are going to show up at some point, probably later in the summer into the fall. So I would expect that downward pressure on prices is going to start building. Would that lead to a 9 to 18% drop in prices like CMHC or Evans et al. Said last week? It might be a little bit of a stretch. It might be an issue of which price measure you're talking about. Maybe it's less of a stretch if you're talking average prices, but if you're talking about the RPS home index, that would be a bit of a stretch to get that kind of price decline. But we do expect, I think, our current base case is now peak to trough price declines in the RPS home price index of around 7%, I believe. So it's a material decline. It's probably the worst decline with that on a national basis that index has ever shown. And then beyond that, then on kind of a more longer term, you get into issues of immigration or in-migration. How's that going to look like? Longer term interest rates, I agree that they're likely to stay low for a long period of time. But high unemployment is going to be around for a long period of time as well, which was going to keep a demand contained for a period of time. So I see that's more of a kind of phases, short term, very near term, very little change, slow activity, and things are going to pick up a bit as the economy reopens, and that's going to be a lot of variability across the country. And then later this year, probably a bit more downward pressure on prices.
Okay. And Benjamin, your thoughts on that, and maybe the arrears. I know Robert mentioned the remarks from CMHC earlier in the week. What your thoughts are on prices and volumes and things like that?
Yes, I think that clearly, as was suggested, the signal that you get from the market now is meaningless. When you have volume going down by 60%, sales and new listing, and people who are in the market have to be in the market, because otherwise, why will you be in the market? Then you have forced sales and you have very little volume. I'm not even looking at the numbers because they are meaningless. The price signal that you're getting is meaningless. However, we are getting weekly numbers and we are opening up. The market is warming up. So while we start, warming up, the true nature of the market, the true face of the market will be revealed, and we'll see how weak it is. And it will be weak. It will be weaker. I think that the activity will go down. There will be more supply than demand. I think that you will see completions coming to the market. You will see some forced sales. You will see people trying to get rid of their units. Investors clearly will not be there. And that's an issue. Add to it the fact that we are losing about, 450,000 people in terms of rental demand because of new immigrants and non-permanent residents. That's significant in terms of the impact on the market. So this market will slow down. There is no question about it. The question is how much. And here you have to look at the composition of the slowdown. That's why when we talk about a decline in house prices, when you predict where prices will go, you must be specific about what kind of index you're talking about. Are you talking about just the simple average, which includes, low price properties, high price property, or just you look at the same index like the benchmark? This is very important because if you look at the nature of the slowdown, most of it is coming from the changes in composition. Namely, you have more activity in the low end of the market and less activity in the high end of the market, which means that the composition factor is the number one reason why prices are going down. If you compare apples to apples, the same unit or similar units, the price is actually going up, not down. And that's why you have to be very specific talking about what index you're talking about. We see it clearly in the GTA, in the condo space, where most of the activity is really happening in the, relatively cheap units, not the expensive one. And that's where I see the mismatch. The demand is for relatively cheap units, the supply is for larger ones, and that's where the mismatch. We did a survey among Canadians, and we found that close to 30% of homeowners are telling us that the low interest rate environment and the fact that the market is now getting softer will encourage them to consider and go ahead with a second unit as investors. So it's not just negative. There is also some positives, people taking advantage of that. We have to remember, and that's the reality. If you look at the job market, as I suggested, the most significant damage was among low income Canadians. Those are mostly renters. There is a huge amount of people, number of people, that are not impacted financially by that. They get their income, relatively high income. They have relatively stable job, especially if you're a government employee, you're safe. And you look at the situation and say, you know what, I can actually take advantage of the situation. And we see 30% are telling us they might do that. So it's not just negative in terms of demand, it's also positive in this sense. So that will add to some sort of demand coming from the other side. I think it's very interesting and worth thinking about. It doesn't mean that the market will be positive, it will be negative, but that will soften how negative it can be. So overall, if you look at the benchmark, namely the same type of properties, as opposed to the composition factor, I think you will see prices going down, but not by 18% by any stretch of the imagination. Second, if I have to look by type of properties, I think that the main impact will be on the condo space as opposed to the low-rise space, because the low-rise space already went through its corrections through B20. The condo market did not see that. And within the condo market, I see more damage happening in the higher end of the market as opposed to the lower end. That's the way I see it.
Okay, and Derek, your thoughts on that, and maybe weave in a little bit on the refinance market as well.
Yeah, I mean, we're actually at the more the optimistic end for the housing market. It's consistent with our general forecast, and I think Benny did a nice job sort of highlighting some of the better spots. It's not all negative, and we do have sales rebounding. In fact, early indications are May will see a better month after that dismal April. So the market is beginning to thaw a little bit, but again, it's predicated on employment, and our view is that come June, we're going to start to see a stabilization in net job losses in our baseline, and then a very moderate improvement going forward. Low rates will help and the like. So, consistent on pricing, we would have sort of flat to slightly moderately down in the near term. Nothing like a double-digit decline. Again, not consistent with our baseline. And I guess refinancing, that's bit of a different animal. We did see, unlike the sales side and some of the new purchase mortgage activity, we did see a little bit of a bounce in April, in March and April on the refi side. Things may be cooling off a little bit as we get some of the May data in. But overall, a market that's outperforming a bit. One thing that's going to be a bit of an impediment to refi is the fact that we haven't seen rates drop as much as sort of bond yields. And this is a bit of an international phenomena with some of the ongoing risk built into mortgage rates. That's prevented some of the decline. So that doesn't mean that some people won't find it attractive to refinance, but it's going to be more the latest vintage in sort of 17 and 18 that took out rates at a higher level and that can refinance at a lower level now and blend in maybe some new money to pay down debt and the like. So yeah, I've seen some moderate growth there on a trend basis since COVID broke out.
Okay, let's share with the audience then the results of that poll about the reductions, and we see that sort of 6 to 10% reduction area, probably a key area there. Although some people think more dramatic than that, some a little bit less. So interesting results there. Let's close off, or not. Well, we've tried to weave in a bunch of the questions we've gotten through the piece, but one of the questions that came up through the presentation was on expectations on changes in mortgage regulation. Are we going to see a change to 10% down? Are we going to see other changes on that side from a government response to kick the housing market back into gear?
Let me try to speculate here. Clearly, I think that the head of CMHC is telling you what he would like to see. And I think that his view is respected in Ottawa. I think that the government is graduating to the idea that not everybody has to own a house. And the cost of owning a house at all costs is too high. and you have the head of CMHC, the agency that's supposed to promote home ownership, is telling you rental is actually a good solution. So I think that this kind of a crisis probably will lead to an acceleration in the process of making sure that home ownership is not coming at all cost. This means that maybe B20 will stay as it is, and I will not be surprised. I will not be surprised if down payment on insured will go to 10%.
Okay. Derek, your thoughts and on changes to potentially land transfer taxes or any other stimulants?
Yeah, I mean, anything's on the table these days, in terms of kickstarting the economy. We're seeing that. It seems like there's almost every week there's a new announcement on a loan program. Haven't heard as much from the city and the province in terms of it's really been a federal story more than anything. So I wouldn't rule anything out. No, I don't hear anything that's imminent of moves on land transfer tax. But I think, again, there's the assumption there. They're kind of going as they see fit. There's still a hope that we're going to see, as reopenings happen, a bit of a rebound in activity. And if that doesn't happen, then yeah, they're going to maybe be potential areas to kickstart things. I think housing, if it really weakens more than expected, you could sort of hear some rumblings about this. In terms of any kind of changes, as per Evan Siddle speech last week, I think it would obviously be a wrong time right now to start raising down payment rates. You don't want to see any kind of big tightening right now. I don't think, in terms of longer term benefits to financial stability, would outweigh some of the costs in terms of weakening the market even further and contributing to potential financial stability problems. So I don't see any tightening there, at least in the very near term, as we're going through all this uncertainty.
Okay. Well, sadly, I think that we've got to leave it there. So Benjamin, Derek, Robert, thank you very much for your time, your insights and thoughts. Very informative. And thank you very much to our audience for joining us today and participating in the session. This session is being recorded, and we'll get that link out to people, and we'll be able to share that as we go forward. Again, as I said at the beginning, we're going to do a quick survey at the end to the audience, get your feedback and thoughts on other sessions that we have in mind out there. We'll do that, but we do want to say, again, thank you. We hope you and your family stay safe and you adjust to the maybe daily changes to the marketplace, but please stay away from Trinity Bellwood parks or any other tech parks out there. So thank you very much for your time today.